$48,800. That's the median price of a home in America right now. Not in Manhattan, not in Beverly Hills. The median, the middle of the country. The average Tuesday, you are lying on the couch in an apartment that costs you $1,470 a month. And you are doing the math that doesn't work. You've done it 3 times this week, same numbers. You have a credit score of 694 and a student loan payment that hits on the 15th like a clock. The house you grew up in? The one your parents bought in 2001 for $148,000 is now worth $390,000. You know this because you check Zillow on your phone at night. Like other people check Instagram, you check it the way you'd check a wound, just to see if it's gotten worse. You tell people you're saving up. You tell yourself you're being smart. But saving at your rate means another 4 years before you have enough for a down payment on something that might be worth less by the time you get there. The market is not waiting for you. It has never waited for anyone. This is where most people stay. Not because they're not smart enough, not because they don't work hard enough, but because they are optimizing for comfort when they should be optimizing for position. The two feel similar from the inside. They are not the same thing. You read a forum post at 11:30 on a Wednesday. Some guy, nobody famous. No credentials listed, talking about a house he bought in 2019 in Columbus for $117,000. He put $8,700 down. He rented it out. The tenant paid his mortgage. 4 years later, he refinanced, pulled out $41,000 in equity, used it as the down payment on the next one. The first rule at Zero: your obstacle is not money. Your obstacle is that you are thinking about real estate the way a renter thinks about real estate, as a cost. The moment you see it as a vehicle, the whole road changes. You start studying the market in your city the way you used to study for exams, except this time you actually care. You learn what a cap rate is. You learn what cash-on-cash return means. You learn what DSCR stands for and why it matters more than your W-2 when a lender is deciding whether you can carry an investment mortgage. You learn the difference between a Class A multifamily building with a 4.5% cap rate in a prime zip code and a Class B rental 3 miles outside of that zip code trading at 6.8%. You are not ready to buy either of them, but you understand the difference. Understanding is always the purchase before the purchase. You find the property on a Saturday morning, not online. Your coworker mentions it. Offhand in the break room, her aunt is selling a duplex. Wants to be done with it. Needs to close before the end of the year. It's a 1960s brick duplex in a working-class neighborhood that has been quietly gentrifying for 2 years. 2 miles from a hospital that just announced a $200 million expansion. She's asking $218,000. The units are rented, both of them. The combined rent is $2,100 a month. You run the numbers in your car on a napkin. You run them again at home on a spreadsheet. You talk yourself out of it for 4 days. Then you call her. You put 20% down, $43,600. That takes you to zero. Your savings account wiped clean. You feel the way you imagine people feel jumping out of planes, terrified and awake at the same time. Your investment property mortgage rate comes in at 7.1%. Your monthly payment is $1,174. Your units bring in $2,100. After taxes, insurance, and a maintenance reserve, you set aside $200 a month without fail. You clear $486 a month. That is not life-changing money. But you also know that someone else is paying your mortgage every single month. You learn that a property manager will cost you 8 to 10% of gross rents. You cannot afford to hand that margin away. Every decision teaches you something the textbooks don't have. The appliance that breaks on Christmas Eve, the tenant who pays 2 weeks late but always pays, the neighbor who calls to say the gutters are overflowing. These are not problems, these are tuition. 18 months later, the duplex has appreciated.
The neighborhood is exactly what you thought it was becoming. A coffee shop opened on the corner, then a CrossFit gym, then a small brewery.
The hospital expansion broke ground. Your Zillow estimate, which you now look at with a different set of eyes, shows $261,000. You have $46,000 in equity. The cash flow has continued. You've saved $14,000 in that time from your job, even with the property expenses. You are 29 years old. Your net worth is $68,000. That number was 0 2 years ago. The second rule: the house someone else pays for is the only house that makes you richer while you sleep. Everything else you own is just furniture. You refinance the duplex, pull out $28,000 in equity. It increases your payment by $188 a month. And it feels wrong in your stomach the way it always does when you pull money you didn't think you had. But you understand now what that Columbus guy understood. You are not spending the equity, you are repositioning it. You use $22,000 as the down payment on a single-family rental. A 1,400 square feet ranch house in a suburb where the median rent for that size is $1,480 and the purchase price is $197,000. You close in 43 days. Your investment mortgage rate is 7.3% on this one. You spent 3 months before that closing making yourself a better borrower. You now have 3 units, 2 in the duplex, 1 in the ranch. They bring in $3,580 a month combined. Your day job still covers your life. The real estate is separate. It is a machine you are building on the side, and it runs whether you think about it or not. You are 31. Your real estate portfolio is worth approximately $458,000. Your outstanding loans are $302,000. Your equity is $156,000. The number feels unreal. You check it not from anxiety, but from disbelief. You spent your 20s watching a $48,800 median home price feel like a wall. Now, you are sitting on 3 times that in equity. You built in 5 years through decisions other people said were too risky. You drive the same car, you eat lunch at the same places. Nobody at your office knows about any of this. You've noticed that talking about what you own makes people strange. Either they want a piece of it, or they want to explain to you why it won't last. Neither conversation is useful. You've developed an allergy to both. You find a 6-unit apartment building built in 1971, all rented. 2-bedroom units in a mid-sized city where the vacancy rate is 4.2% and rents have climbed 2.9% annually for 3. The asking price is $640,000. The current net operating income is $41,1200. You do the math. That's a 6.4% cap rate for this market. That's a number worth paying close attention to. Nationally, apartment cap rates sat at 5.7% in 2025, and this is better. You spend 6 weeks underwriting the deal from every angle. You find things the seller didn't disclose. You use those things to negotiate $38,000 off the price. You close at $602,000. You bring in $82,000 from a private moneylender you've spent 8 months building a relationship with. Coffee, quarterly updates, 2 dinners where you never once asked for anything. The lender makes 9% on their money. You get a building. Everyone wins. This is the transaction that changes the texture of what you're doing. Before this, you were a person who owned rental houses. After this, you are operating a small commercial real estate business. The distinction is not cosmetic. The financing is different. The insurance is different. The tenant profile is different. The management overhead is different. For the first time, you hire a part-time property manager. You pay her $340 a month. She is worth 3 times that. The third rule: below 5 units, you are a landlord. Above it, you are building a business. The moment it becomes a business, your decisions change, the language changes, the leverage changes, the way banks look at you changes. For the first time, your real estate income has crossed 5 figures in a single year. You file taxes differently now. You have a CPA who specializes in real estate investors. Your combined portfolio now generates $7,140 in monthly gross rents. Net of expenses, debt service, and management, you are clearing $2,190 a month. For the first time, your real estate income has crossed 5 figures in a single year. You file taxes differently now. You have a CPA who specializes in real estate investors. She introduces you to cost segregation. You learn that the IRS allows you to depreciate. You learn what a Schedule E is and why it has been quietly reshaping your tax liability. You are 34, 9 units total. Real estate holdings worth $1.11 million, outstanding debt of $714,000, equity of $386,000. You cross $1 million in real estate assets. The number lands in your chest like a fist. Not from pride, from weight. You feel the weight of having built something real. Then you get back to work. You get a call about a 24-unit apartment complex. A developer is selling it off. He overextended himself and needs liquidity. It's a $2.4 million deal. You don't have the cash, and for the first time, you don't even have the equity. But you have something better, a 5-year track record. You reach out to your private lender and 3 others. You offer them a piece of the machine. You learn the language of GP and LP, general partner, limited partner. You're not just buying a property, you're buying their trust. You raise $550,000 in 3 weeks. The machine isn't yours anymore, it's a fleet, and you're the captain. Day 1 at the 24-unit complex. You walk the halls with your property manager. It's no longer just a building, it's a small neighborhood under one roof. Everything is multiplied. 24 furnaces, 48 toilets, 24 families whose comfort depends on the system you've built. The margin for error has vanished. You find the leak, not a water leak, a financial one. The previous owner was paying for water on a single meter. You install sub-meters. You find $1,200 a month in hidden profit. That $1,200 a month isn't just extra cash in your pocket. In commercial real estate, every dollar of net operating income is magnified by the cap rate. At a 6% cap, that $14,400 in annual savings just added $240,000 to the value of the building. You created $250,000 of wealth with a plumbing decision. This is the wealth effect. You are no longer trading hours for dollars. You are trading systems for equity. The compounding has finally left the station.